Now, let's talk about what's happening to the markets. And my next guest has some simple investment philosophy. Just steer clear of cash-devouring sinkholes. Well, figuring out how to do that might be just a little bit more difficult than that sounds. And that's why we have Michael Harkins, a partner at Levy Harkins Co. Now, Levy Harkins is beating the S&P 500 by about 15 percentage points this year. 15. And you managed to accomplish this last year. I'm not going to predict what happens in the future, but you seem to have a little bit of a track record here, Michael Harkins, and you say that it has to do with finding companies, and they're not so esoteric, because when I read the investor letter, you mentioned companies like Tupperware and Caterpillar and John Deere, companies that we've all heard of.
Yes, and thank you for the nice introduction. But, Pimm, the truth of it is investment professionals hardly ever disagree about what is a cash-producing company and what is a cash-draining company. Nobody could ever look at General Motors in any of its incantations and say, oh, well, this is a business that generates lots of cash. It doesn't. You either put back in CapEx and receivables and a finance subsidiary, you put back all of this year's earnings, all of last year's depreciation, and then some, or you won't have an asset competing against the Japanese 3 years from now. It's just not that hard, even for amateurs, to know the difference. And I happily say the Value Line survey helps me greatly in this, because it allows you to see results over the last 15, 18 years for 1,750 companies.
All right, but that seems so simple. The reason I stop you is it seems so simple, and yet there is a Wall Street machinery at work as we speak,
yes,
marketing an initial public offering of GM, General Motors. Someone's going to buy it.
Someone's going to buy it. It's not going to be me and Levy Harkins' clients. I can tell you that for a certainty. Imagine somebody having such an ego that they think their economic forecast for next year is so good that it defeats 70 years of miserable capitalist experience, which describes General Motors. There wasn't a time in all those years when GM paid a dividend that it wasn't doing it with borrowed money. I don't have as big as ego as that. I think I can get right what's a good business from a bad business, what's a cash-producing business from a sinkhole, as you say. And I think I know something about what price to pay for that. It works year over year, really does. And I don't have any worry about talking about it publicly, because people either gravitate to this or don't in about their first 15 minutes on Wall Street.
They either get it or they don't.
They either get it or they don't. And that is not my observation. That's Warren Buffett's observation. He says he'd never met anybody who spent 1 year doing something else and then starts doing this.
Well, in your letter, you do make the point that there seem to be so many investment professionals who are trying to divine the future of the global, if not the U.S. economy, and yet it would be better time spent if they looked at specific companies and just looked at how these companies operate, what businesses they're in, and indeed whether they generate cash or not.
And whether they generate cash is key. Whether they have moats around them, you know, because even America in agony is still America. These are very tough times. And if you don't have a management that understands digging the moat deeper every day, come what may, come what quarterly results come from this, then somebody will jump over your moat in 2 or 3 years, and those great cash-inducing properties will be lost to you. So any management that comes on the conference call and takes congratulations, great for the great quarter, guys, good on you, I always think these aren't very serious people.
So now I just lest anybody think that we're just talking about old line companies like a Tupperware or a John Deere or Caterpillar. Also in your letter, technology companies. Akamai was one that you mentioned.
Akamai is one. Who's ever seen anything that generated more cash than Google? They have $100 a share in cash on their balance sheet, which they got the right way. They didn't borrow it. They have no borrowings. They didn't sell off something. They've never sold anything off. They didn't do an IPO, and it's cash that's left. That's $100 a share that the company made. You look at that for a second and you say, well, if they earn $30 a share next year, and I think they will, and I subtract the $100 in cash, so really I'm only paying about $500 a share for this stock, not the $600 it's quoted at, and they make $30 a share next year? Goodness grief, that's a pretty good-looking investment.
So why does Wall Street seem to make it more complicated, or indeed why do people want it to be more complicated? Because you must have met investors who say, Michael, come on, this sounds way too easy. Find me something more difficult to figure out.
Every day at lunch I meet people like that. But the thing is this, the news media gives a torrent of information at us all the time. I mean, it's 24/7 now with Bloomberg terminals and Bloomberg radio. I know you're on at 6 o'clock in the morning, increasing the size of the torrent. So much of it either doesn't mean anything or it's not investable. And by not investable, I mean, George Soros had a marvelous theory that he has expounded on for 23 years, reflexivity. It says the markets influence the future. The markets create reality going forward. And it's much more important to know that than to be studying economic statistics that look at the past. You don't really care about the past as an investor, except you want to know good businesses from bad. But the past doesn't get you anything in studying markets today. You've got to look forward. And that's reflexivity. Everyone takes George Soros with enormous seriousness, but they don't take his idea with very much seriousness at all, as he has pointed out time and again.
So the idea of reflexivity, just to help me understand it even more clearly, is that market participants and people that are in the market, they end up affecting the future much more than looking at any kind of economic analysis that goes back into history.
Right.
I'm speaking about the markets and investing with an expert, Michael Harkins from Levy Harkins Company. And I can say that he's an expert because at least right now he's beating the S&P 500 by 15 percentage points this year. He also did that last year. Michael Harkins, before we get to an in-depth view of reflexivity, and it has nothing to do with mirrors, the bond market. We were talking during the break about what you see is specifically in terms of retail flows into bonds and bond funds, but it's not limited to the retail crowd. Yeah. Institutional and pension fund investors, the Harvard Endowment, for example, $1 billion in U.S. Treasuries.
And I think it's foolishness. And I say that because I'm so well aware of the arithmetic of the bond market. So let's have a little thing about that for a second. This is not my bloviating. This is how bonds work. If you came in today and you bought the most popular bond trade in the United States, you probably bought the 2 5/8 Treasury bond due in August of 2020. Okay. You paid something like 101 1/4 for that bond. And 1 year from today, if any sort of prosperity breaks out in the United States, if anything like normalcy even approaches return, interest rates will go from about 2.5% to 3.5%. Okay, at 3.5%, that bond will sell at less than 93.5. That's just arithmetic. It has to go to that lower level to compete with bonds with 3.5% coupons.
101 to 93.5. Just do the math. This is just an 8-point move.
It's an 8-point move when you only stood to make 2.5 if things went well for you.
And you'd have to hold it.
And you'd have to hold it. Now, here's the thing, Pimm. This time next year, you will be faced, at that moment, with a really miserable decision. Because you'll have to say to yourself, do I sell this thing and take an 8-point loss? Or do I hold on to it, hoping interest rates don't go higher? If the following year interest rates go to 4.5%, still in the post-war years extremely low, but not the terrified level they got to. Okay, at a 4.5% yield, that bond now sells in the mid-80s, about 85.5. You took a 15-point loss in something you couldn't make any money in. These are breathtaking. You don't settle for a miserable return while taking an equity risk. That's just a lot of return-free risk. It's foolishness.
So the idea is that people are not actually comparing the risk in equities with the risk in bonds because they fear what? That they're not going to get their principal back? But okay, in 10 years, I'm assuming that you look at it and say Caterpillar will still be around in 10 years, Tupperware will still be around in 10 years, John Deere will be around in 10 years.
You say correctly you'll get your principal back, but will you get your purchasing power back?
That's what happens in that space of time.
There was a brilliant economist, he's still around, but Ray DeVoe used to produce the cost of living it up index because he said it's so better reflected what you and I know as consumers. And I've often joked that this real CPI index, it looks like the Unabomber rate to me. It describes somebody's life that's got nothing to do with my life, my clients' lives. They didn't come to me from trailer parks, and they're not looking for me to send them back there. So it's very important for me to realize in the back of my mind, prices go up much faster than the BLS computes these statistics.
Right. Well, the government's version of consumer price indices right now has no Social Security increase mandated for this year because they have the CPI, which shows that X food and X energy, nothing's happened with inflation.
And imagine if in our lives we had a conflict of interest like that. The government creates the money in one hand, and then it turns around in the BLS and tells you how valuable its product is. and then the Social Security Administration, of course, is the greatest, it's at most risk if the CPI goes up, because it loves to claim that it doesn't have to make these COLA payments. These are horrific conflicts of interest.
I have to find out from you, you've obviously been following the case having to do with PIMCO, BlackRock, the New York Federal Reserve writing a letter to B of A, to Bank of America, saying that they'd like them to actually buy back some of these mortgages. What do you think about that situation?
Wow, America's savers have already been bludgeoned with these ultra-low interest rates. And now you're going to bludgeon them some more? I mean, people don't understand. Bank of America doesn't own those mortgages. Those mortgages are owned in bond funds, and insurance companies and annuity schemes all over the place. So if you can't foreclose on somebody who hasn't paid for over a year, you're really hurting the guy who owns those bonds, the retiree in Florida who's already been badly hurt. By the way, have we heard of a single case of a foreclosed on guy coming forward and saying, they foreclosed on me and I was current on my payments? I haven't heard of a single case like that.
Talk about reflexivity in the time that we have. Reflexivity, George Soros, this idea that market participants really change the reality of the marketplace.
In physics, you are not looking at thinking participants. At physics, nobody influences what you're looking at. Okay, but in markets, they're all thinking. That's what's more. Reflexivity is such a powerful idea because it gets more interesting as the outliers get bigger. It's sort of got this kurtosis, this fat tail risk built into a brilliant idea. Markets influence the future. They influence it far more than they are influenced by today's obvious fundamentals. You will not be looking at the same world if the stock market goes up a lot. The world will be improved from the stock market having reinstituted confidence. That's what people don't quite understand about how powerful an idea what George Soros' original nostrum was.
And the idea that these knock-on effects, they themselves have other effects that we cannot predict.
Yes, and it describes the world, the actual functioning world, so much better than the efficient market theorem, which is dominant in every university, has been proved ruinous for people's saving and investing ideas, and has cost society a ton of money. We couldn't have gotten into this mortgage mess without the efficient market theorem being the dominant on-campus thought.
Well, and also, if they took a look at your returns last year and this year, you're doing a good job to dispel them as well.